All right, good afternoon, everyone. We're just going to get started here now with the tax presentation. So appreciate everyone coming in today. So we're going to talk about, how to save some money on taxes, how you can use it for your clients to save money on taxes, and how you can use it for yourself. Yeah. Oh, all right. Sounds good. Thank you. Appreciate it. All right, cool. So today's whole presentation is just going to revolve around tax planning and why you need the plan, otherwise you're going to fail. So just going through this here. So who am I? My name's Tony Hong. If you forget, it's the CPA dude. So we're a tax planning and strategy firm, and we help you save money on taxes. Also file your taxes. And speaking of the devil, if you haven't done it yet, 9/15 is your due date for S corporations, partnerships, so don't miss that, otherwise you're going to face the penalties. And then your personal tax returns, those are due 10/15, so October 15th. Got about a month left, so if you file an extension, it's almost that time again, so just as remembering that. And yeah, overall, we got a team of 32 people now that serves clients across the whole US. Big niche in real estate. We got 67% of our clients that own a rental at least, if not a lot more, and then also a lot of business owners and some high net worth W-2 folks. And the big thing that I just want everyone just to remember is have some plan versus no plan. So you wouldn't build a house without a blueprint, you wouldn't go work out without a workout plan. So why would you file your taxes without a tax plan? And it can be as basic as contribute to a Roth IRA, solo 401k, or it can get super complicated. You do a whole bunch of entity structuring, and then also do a whole bunch of income shifting deferrals. So this is really how complex you want to have it. More general rule of thumb is more money, more problems. So that phrase is pretty true for your taxes also. So the Ben Franklin quote, I always say, if you fail to plan, you plan to fail. So yeah, just don't, I don't know if anyone likes failing in here. Does anyone like failing? Probably not. Yeah, everyone wants to be a winner and wants to succeed. So how I learned all this stuff was kind of a little bit by accident, a little bit by design. So my parents grew up in their Chinese restaurant. I think they put me to work when I was 11 years old. And then I just did that whole thing. And then they got into real estate themselves during the 08, 09 crash. And then I just got dragged along with that. So then, naturally went to college and then failed out as a bio major. And I was every Asian kid's got to be a doctor, right? So it didn't happen. I got straight B's. So then I switched to accounting, and then accounting was oh, okay, this makes sense. And then my parents, of course, are well, now you got a CPA license. How do you save more money? And I was I don't know. They don't teach you this stuff in school. They don't teach you that on the CPA exam. So it's actually quite ironic. Even if you have a license and you go through the schooling and everything, it doesn't mean anything. So what I did then was just go through the whole path of just paying my dues, working at, public accounting companies. I worked at Novogradac for a bit, worked at KPMG for a bit, and really kind of learned some ropes there. But the big thing was actually just the internet. So just piecing it all together and then understanding and having that baseline of the accounting knowledge. So just listen to other mentors in the real estate space, the small business space, and then was able to just go practice in my parents' portfolio. And then later just became on my own portfolio and then my own business. So a lot of the strategies that we use today, it's we used on ourselves first to test it and make sure it's all good. No audits blew up in our faces, so we did something right. So yeah, the big thing that I wanted to bring up today was the big beautiful bill and the updates that are from there that's going to be apparent for what you guys need to know for yourselves and for your clients on that side. So this came out on July 4th. It was kind of a little firework. I was pretty excited about it. There's some good stuff in there. Some people, other parts that are not tax related, I don't think they were that good, but on the tax side, they came out with some good updates. So today we're just going to go over those updates and then how that will affect you also. So this is the biggest one that came out of the tax law update was 100% bonus depreciation. So for those of you who don't know what bonus depreciation is, it's essentially, when you buy a property, you can depreciate part of that house over 27.5 years or 39 years. And that's a really long time. And you're not going to get that big of a benefit. It's a good benefit, but what bonus depreciation is that you can take way more upfront in the beginning year by running a cost segregation study. So essentially, this is how the rich don't pay taxes, is that, you could have a $100,000 down payment that could get you, say, $800,000 house. and you can get up to well over $200,000 of a write-off. So you paid $100,000 out for a $200,000 write-off. So this coming back to 100% is huge. Previously, it was going to be at 40%. So it was phasing down each year and it was going to go away. So with this coming back, it's really a big incentive for you to start buying real estate, having your clients buy real estate again. Previously, it was like kind of a mixed bag of like if you wanted to buy as much for the tax benefit, but now it's like a no-brainer to keep on buying for tax benefits for the house. So 100% bonus depreciation is amazing right now. So this is like solidified. It's not going to phase down like it was going to be previously. The second part is Section 179. So, what they're trying to do really is to incentivize a lot more like domestic manufacturing, domestic companies. So they increased this to $2.5 million a year. So previously it was about $1 million, and now they boosted up to $2.5 million. So this Section 179, the most common thing you're probably used to hearing is like writing off a G-Wagon, writing off a big heavy vehicle, but you can also use this for other equipment in your businesses. So this is like just to promote more domestic spending, more or less. So once again, this is where you can go buy, say you want to buy an RV, and that RV is 120 grand. This is actually my neighbor's example. Her dad unfortunately passed, and then she's like, I'm not going to do this nursing thing anymore. So then she drained all her retirement accounts, but then she had like a fat tax liability. So then what did we do? We ended up buying like an RV so she could rent it out on outdoorsy. So with that, it was like a $120,000 RV. I think she put like $10,000 down and just financed the rest. But that year with Section 179, you were able to take the full deduction. So we wrote off the whole RV at 120 grand. So it roughly saved her about 45 grand in taxes. So she made $35,000 that year because she did 10,000 out, saved 45. So she netted the difference. So taxes, it's really like a timing difference. So you just want to keep on kicking the can down the road. I think most of us are familiar with 1031 exchanges, and that's just keeping like the can down the road so you don't have to pay the amount of taxes. So Section 179, really powerful. It's up to $2.5 million now. So you want to really keep on investing big. And then actually going back to 100% bonus depreciation, if anyone has any clients like more in like they're more of a manufacturer of any sort, this is one new provision for the next 4 years is that you can actually expense the full building. So generally you can't expense like the roof and the 2x4s and everything. If your client actually uses it for like manufacturing, you can expense the whole entire thing. So if you buy like a $2 million warehouse and they're going to be producing widgets, you can actually write off the full $2 million. Normally you can only write off, maybe like 1.6 of that because you have to get the roof and the 2x4s go really slow. So that's another benefit about the 100% bonus depreciation coming back. And then this
family farm still in that category?
Family farms? Yeah. Oh, in terms of Section 179?
Yeah.
Yeah. So any type of manufacturing equipment, any type of farming equipment, you can always use Section 179 and pair it with bonus depreciation. So the two of those can be tied together. So I actually grew up in Fairmont, Minnesota. I'm not from the Bay originally. I moved here, I think 8 years ago. It's home now. I'm never going to move. It's beautiful. Geez. Just very expensive taxes. But yeah, a lot of the farmers in Q4, whenever they had a good harvest, you could always tell it was a good season or not because everyone would have like brand new F-250s. So they would always not want to pay more taxes or have new tractors. And you would just see, but it's like a bad season though, bad harvest. It was, no one had new toys at all. And yeah, and then feel free if anyone wants to chime in and has questions along the side too. Jack's pretty dry and boring subject, so any type of combo is a little bit more entertaining than me speaking. Let's see here. QBI deduction. So this one's actually like huge for everyone in this room because everyone, except maybe Jeff, is 1099, right? Anyone else W-2?
There's a couple W-2s, but
okay, you're one of the few breeds, huh? Okay, cool. So this one is actually huge. So this is like 20% off of your taxes if you're not using it today. So this is now permanent. It was going to phase out with the old tax law. So now with the big beautiful bill, it's permanent. However, this does have its limitations. So if you make too much, it does phase out. So you don't get the 20% deduction. However, there's always a loophole there's not always. Many times there's a loophole within the strategies in itself. So the QBI deduction, even if you make too much, when I say too much, we're talking about like 380 married couple, 190 single. So that's when I say too much. Well, that's what the tax code says is too much. But on here, you can actually hack it. And if you are a 1099, then you can actually have an S corp. And your S corp, there's a hack where you can pay 2 out of 7 of your net income, and then you'll qualify again for the 20%. So it's like if you don't do anything, you lose it after that income. If you do something, you actually get it. But if you're not structured properly, you're going to lose out on it. So the QBI deduction is huge for everyone. And this actually came out of how C corporations only get taxed at 21%. So C corporations are only taxed at 21%. Previously, they were taxed at 35%. So all small business owners were like, oh, how about me? Like I get nothing, just a big, scary corpse get a deduction. So this came out of it. So the QBI deduction is just a huge, big benefit. And it's just a 20% haircut on your net income. So if you're not optimized for it, double check it. It's on your 1040 tax return. So if that box is empty, you probably want to seriously check that because, $20,000 on, say, $100,000 in net income, that's right there. 20, you're missing out times 0.2. It's like $4,000. I think everyone would take $4,000 for free. All right. Yeah.
What's S corp?
So an S corporation, it's not technically a legal entity. It's a tax election that you can make. So you can be an LLC or you can be a corporation. And then you can raise your hand and say like, hey, IRS, I want to be taxed as an S corporation. So I call it like lipstick on a pig. So it's like you got the pigs are like the LLCs or the corporations, and then S election is just like you just say, I want to be taxed as an S corporation. And the reason why is because you save a ton in self-employment taxes. So that's your Social Security, Medicare taxes. That is very expensive. So you can really start structuring that way, and that's why S corps are so important for 1089 folks.
And how do you do that? What do you need?
Oh, you just need an election. It's Form 2553. And then you just send that through the IRS. So you can either backdate it for this year, or if you want to start fresh next year, you have to do it in the first 75 days of the year.
So the IRS doesn't ask questions?
Oh, the IRS will tell you nothing ever, because the less you know, the more they make. Yeah, they're never going to be like, hey, you're overpaying taxes. Like, it's not.
No, I know
Yeah.
that,
Mm-hmm.
but I'm just saying, what are the qualifications for an S corp?
Oh, qualifications. It has to be 100 shareholders or less, and then you just have to be a U.S. Resident for tax purposes. Yeah. Mm-hmm.
Now, is that a form you can fill out and mail out?
Yeah, we can do it. You can do it. ChatGPT can do it. Form 2553. So that one will save you a crap load of money. Actually, just talking about S corps on that topic is like if I take an example, if you make $100,000 as an LLC, and then you make $100,000 as like an S corporation or even a sole proprietor, so you draw the line here, you'll pay $15,300 in self-employment taxes, not even income taxes, right? So that means you'll pay $15,300. Now, if you're an S corporation, if you just literally say, I'm going to pay myself 50 grand and take a distribution of 50 grand, now you shave that in half. So you're only paying 7.65 grand in self-employment taxes. So if you're not doing that today, you seriously should. Otherwise, once again, you're just leaving money on the table. And this is where reasonable compensation plays come into play. But just make sure, and then that's where you can optimize for that QBI deduction is how much you pay yourself. So that's where you take, you get really optimized on that side. So it's a lot of ways to put money back in your pocket by just literally using the tax code just a little bit more efficiently.
Got another question. So, what's the least amount of shareholders you can have in an S corp?
Oh, one, just yourself. Yep. Mm-hmm. Yeah, exactly. And then if there's any like straight up killers, who sells the most in this room here? Raise your hands. They're pointing fingers.
What, Jeff?
Oh, right here? Okay, the lady drinking tea. Okay, so let's just say Janice here sells the most, and then I'm just I know she's a baller actually. So, there comes to a point where S corporations don't make sense. And it's around the $800,000 net income, more on the $1 million guaranteed. But if you know what you're doing, $700,000 to $800,000 in S corp still makes sense. But once you're $1 million plus on net income, you actually want to be a C corporation. The reason why you go C corporation though, is because it's only taxed at 21% versus $1 million on your personal side as an S corp, you're taxed at 37%. So you have a 16% difference there. So that's when C corps could make sense. So C corp, $1 million. If not, don't care. S corp. If you make more than $70,000, you definitely need an S corp. So it's like 0 to 70 is, sole proprietor. I'd probably skip the LLC, and then 70 to $1 million, just say S corp, and then $1 million plus is C corp. Cool. All right. So QBI deduction. Hopefully everyone remembered that one on that side here, and then SALT cap and this stands for state and local tax. Someone thought it was like table salt. One time I was like talking, I was like, what's salt? Like the table salt? I'm like, no, it's state and local taxes. So state and local taxes, this is huge for us here. So like, for your, I would say probably from a stat wise. So it went from $10,000 to $40,000. So it went up $30,000 if you make up to 500 grand. So if you or your clients make $500,000 or less, you get the full $40,000. So that includes your property taxes and your income taxes and your car taxes too. So you get up to $40,000. Now this goes away though if you make more than $600,000, and it starts phasing out through. So 500, 600, it's a little bit less. So you want to stay below $500,000 to get the full 40 grand. And if you're beyond that though, that's where tax planning comes in. Like if you play your cards right, especially everyone being in this room, except Jeff, sorry. Sorry to pick on you, you're just the marketing guy here, you're not a realtor anymore, is that you can actually qualify for real estate professional status. And literally you can just keep on buying more homes to pay no taxes on the federal side. State, you're always gonna have to pay, unfortunately. California FTB, they just love their taxes. So yeah, anyone in this room, you can probably plan down to get at least below 500 to take advantage of the $40,000. Now for your clients, and they're saying like, oh, I don't want to buy such an expensive house, hey, there's tax benefits. So with an extra $30,000 in the property tax increase plus income tax, roughly saying on $30,000 extra at, say 25% effective tax rate, you're making an extra $7,500. So indirectly, you're getting a $7,500 discount on your property taxes, depending on how you want to, say it, just with this tax law change. So this is huge here. And then once again, the SALT cap, there's other ways to work around it though. So there's the pass-through entity tax that California has. So that's where your S corporation makes an election for you, and the S corp prepays the income taxes for you. You get a tax deduction, and then from there also you get a tax credit on your personal taxes. So once again, a lot of ways to score. So I hope after today, everyone can walk out and save $10,000 and put that money back in their pocket. Buy yourself something nice, maybe buy a Rolex or whatever you guys are into these days. Estate exemption, terrible financial advice. I just met Herb, he does financial planning. So I was like, oh, yeah, yeah. We won't talk about the Porsches then. Yeah. So estate exemption. So this was in scare. It went to $15 million now. It was going to drop down about the 6.25, 7 million if the tax laws didn't renew. So now this is $15 million per person, married $30 million. So biggest thing is just to bring up to your clients like, hey, if mom and dad got a crap load of money, you probably want to care about this. Grandma and grandpa, you should probably get some estate plan. We don't do estate planning. We're just like very comprehensive and asking like, hey, do you have a trust or not? And then if not, we just refer them over to our attorney partners. But the biggest thing is like, I just don't want to deal with the mess afterwards. So I'm kind of like setting myself up for an easy walk just in case. And the sad thing about estate exemption, sad thing about taxes is that nothing's guaranteed but death and taxes. So you should always plan around death. You should always plan around taxes because those are two things you have to face, unfortunately. And then strategies for you. So those are big, beautiful bill updates. I kind of just tied them all in on this side. And I can probably just double click into any of these. And then if anyone wants free tax advice, ask away as you can right now. But yeah, the S corporation, let me just see, here we go. Yeah, S corporation. Yeah, the big part here, we kind of gone over that, Form 2553, set up a good reasonable compensation. The only downside of this though, so I talked about the benefits. Now the downsides of it is just more maintenance. So you have an extra business tax return to file now. You have payroll you need to file for. You have to have a balance sheet. So if you don't have QuickBooks yet, you have to go get QuickBooks now. So just a little bit extra maintenance, but it's really how you can save a ton in taxes. So S corporation election is huge. Then income shifting. So these are strategies that you can use. How many people have kids in here? Good chunk. Okay. There. Oh, any kids at all, yeah. 18 plus work counts too if they got no job. Yeah. So income shifting is huge. So if you have kids, you can have kids, you can have parents. Doesn't have to be kids. Yeah, kids, parents on here. Broke friends that are in a lower income bracket than you. You can do some income shifting towards them. So you can either pay your kids, you can pay your mom and dad, pay your broke friend, They just have to work for you though. So they have to do something like legit. So you need like a real job description with real money movement towards that side. But you could shift, so if you have a kid that makes no income, you can pay them 15 grand this year and they won't pay any income taxes on that. Then you can also set them up with like a Roth IRA, and then you can start building wealth for them right away. Kind of all the stuff we wish our parents did, because then we'd probably just be trust fund babies at this point. One fun fact is if you save $10,000 per year for 30 years and you compound that at 8%, you'll have $1.3 million in 30 years. So literally that can just fund it huge. $300,000 is that savings, $1 million is that growth. So that's just huge on that side. So income shifting is a great way. So you got 2 kids, there's 30 grand shaved off on your taxes right away. You got 3, 45, so on and so on. You got the parents that you support. If you're paying your parents, just because, I know I pay my mom and dad, they, clean up some housework for me here and there, but, just make it a tax deduction for you also. So if you're financially supporting anyone, that's always a good idea. And then,
Question regarding that.
oh yeah.
So let's say you pay your mom and dad, but they're getting Social Security. How does that, like just giving back some portion of your Social Security? Can you talk a little bit about that?
Oh yeah, so yeah, if your parents are on Social Security and you're gonna increase their income taxes, that's still fine. So up till about 26 grand, they don't pay anything on Social Security. After that, they just get taxed on 85% of it. So 85%, but they're only getting like $1 grand or 2 per month. So they only get taxed on 85% of that. So they get 10 grand per year. The taxable base is only 8,500. But with Trump's new, tax law changes, Social Security is now exempt, I think 12 or 25. I can't remember the number, but so no tax on Social Security. Yeah.
Does Social Security decrease the amount they give you because you're now having income?
No?
Let's say I made $1,000 a month
Mhm.
as a 65-year-old.
Yeah.
From Social Security. I get $12,000 a year, right? So if Jeff wants to employ the 65-year-old and he wants to pay me 15 grand, right?
Yeah.
Does my 12,000 from Social Security decrease as a result of getting income from Jeff?
I don't think so, yeah.
No?
Yeah.
Okay.
Because you paid in your dues for Social Security for all these years. Yeah. Mm-hmm. Yeah. But the one thing that you do kind of get into a wonky area though is if your parents are on some type of state benefit. So if they're on are they on health insurance or like food stamps, Section 8, those type of areas, probably don't want to do this strategy, just as a heads up. So it's kind of like for those parents that are like, because the biggest thing is like, if you're in the 32% bracket and they're in the 10, like just boost them up to 12, maybe bring yourself down to 24. That's kind of like the idea here, is just to see yourself as one economic unit versus just 2 separate taxpayers. And then retirement. So this is an area where you can shift some money and diversify. Obviously, everyone's probably going to buy real estate. But if you want to, this is like if you bought no real estate this whole year and you're like, crap, I don't want to pay money on taxes. Setting up a retirement account, whether it's a solo 401k, that's an easiest one, or SEP IRA, you can stash up to 70 grand in those respectively. So, combined, that's all you can do. So, 70 grand is a crap load of money anyways. So retirement accounts are good. You can also put money into a self-directed IRA. So if you want to pull that money out later to invest, that's another great option for you there too. So retirement's a big area. Just keep on deferring items down. Those are pre-tax accounts. You can also do post-tax accounts. So you can do Roth accounts. So when you do retire, you pull that money out, it's tax-free. So, and then the magical question is always like, do I do traditional or do I do Roth? And you kind of need a crystal ball to answer it. The 2 questions you want to ask yourself is, number 1, will you make more money when you retire? Number 2, do you think tax rates are more progressive or regressive by the time you retire? So generally speaking, if you think you'll make more money then, and you also think the tax systems get more progressive, Roth could be better for you. But also there's the camp of, I might die tomorrow. So some people don't put money into retirement. So I've been telling my little sister this to put money in retirement, but then she doesn't. She's like, oh, I gotta live my best life. I'm like, all right, dude, you can just pay your taxes, dude. I don't care. Yeah. Uh-huh. Yeah. Mm-hmm.
You make money, pay the taxes on it, put it in the Roth IRA. The Roth IRA investments grow on their own. All of that is tax-free. Right?
All of it's tax-free, yep. Mm-hmm. Yeah. So yeah, if you're say you're in the 22, 24% bracket today, and by the time I retire, I'm going to be at the highest tax bracket because that's like my personality, then it'd be better because hypothetically probably 37, 39, 40% probably Or you just take today and say it's 37%, you'll get all that money at a cheaper tax rate. Yeah.
So kind of, again, tough question, crystal ball, whether to do traditional or Roth. If you're just having trouble deciding, what if you decide to contribute to like 2 different accounts equally to kind of hedge?
Oh yeah.
Does that make sense, or is there anything weird about doing that type of strategy?
No, I used to do that. Yeah. Yeah. So yeah, I used to just put half because I'm like, whatever. I was too indecisive too. So, but at least you're mixed both ways. Yeah.
When you open a Roth, can you keep putting money in there, or is there a limit?
Yeah. So Roth IRAs, there is a limit. I think is around 140-ish if you're single, double if you're married. And then the big thing though is just to do a backdoor Roth IRA. So generally speaking, I say because anyone here, if you sell, you have a light up of like homes, like a couple sales, you could be way over that limit. The better thing to always do is first put into a traditional IRA, and then afterwards do a backdoor IRA. And it's just taxes has a whole bunch of fancy language. All it is put the money into one account, call up them the next day and be like, yo, dude, can you move this to the other account? And that's it. Yeah.
The minimum and the max?
The max is $7,000 this year, and then per year. Yep. And then if you're over 50, it's an extra $1,000 that you can put in. So 8,000. Yep. You can do 8,000. Yep. Mm-hmm.
So what's like the average return on Roth?
Roth, it's whatever you put it into. So so Roth IRAs, traditional IRAs, solo 401ks, whatever it is, those are just like the jars, but you have to still pick the cookies and put it inside of it. So like,
But
yeah.
I thought Roth was like, it would give you like 7% or.
There's no guarantee.
No, I know that, but there's
Oh,
a
yeah.
range.
Oh, it could be negative to a lot. So it really depends on what you want. So like me personally, I just do the S&P 500 VOO ticker. I just buy that every day. So that I think historically through its lifetime is 8%.
Because I mean,
Yeah.
it gives you tax-free.
Yeah.
Like other stocks.
Yeah. Yeah. So in these accounts, you can sell all of it and you won't have to pay taxes within it. So if you want to trade within it, that's totally fine. All the capital gains are tax-free. But if you lose money though, you don't get that capital loss though to reduce your taxes. Yeah. So usually your retirement accounts, you want to be, generally speaking, a little bit not as like aggressive with them, maybe something more consistent. But always that's where like a good financial advisor comes into play. And you can see like, hey, what's the best way for my situation? Because each person's finances are like snowflakes. They're all unique.
A self-defined retirement,
Mhm.
you could put more.
So it's still capped to the type. So self-directed IRA, it's still capped at that $7,000 per year.
No, if it's a solo 401k, individual 401k is higher. It's about 70K.
Yeah, 70K if you do a solo 401k. Yeah, because then the solo 401ks, those are like your umbrellas, and then you can have like sub umbrellas inside of them, and then you can have a self-directed solo 401k. But the flavor is, so you can put 70 grand in that one. Yeah, yeah. So there's a ton of these, and then this is where it gets super confusing with taxes on the side. Boom, boom, retirement. Okay, cool. All right, so yeah, this is like the unicorn that everyone should have in this room. So real estate professional status, bunch of text. I don't know why I did that because I always am a picture guy. So real estate professional status, it's a unicorn of the tax code. What this is that there's a few hoops you have to hop over. Those hoops are going to be 750 hours or more in the trades or businesses of real estate. So you brokering automatically check, right? Number 2 is over 50% of your time. So if this is a side hustle, this actually matters for you. Because if you have a day job and you're working 2,080 hours on that day job, then you have to have 2,081 hours as this job. So over 50% of the time. So that's usually where they'll kind of like poke holes and like make you lose under an audit. So that's the second prong, over 50% of your time. And then lastly is you have to have material participation. So material participation, there's 7 different prongs on that. And the easiest ones to meet is 100 hours, no one else works more than you, 500 hours, or you substantially performed all services. So these are all 7 different prongs. You just need to do one. The easiest one to do for this, so this is for all the rental properties that you own. So like you as a realtor, and then these are for your rental properties that you own. So on this side is like you self-manage all your properties, easy, you're gonna qualify. If you have a property manager, you may have to do a grouping election. So that would mean that you treat, so the IRS looks at it per property. So you have to make a grouping election and say, hey, treat it all as one, so you can do 500 hours across them all. So once, like, what's the whole point of like all this is so you can actually take all the depreciation from your investment units and then offset your realtor income, so you pay $0 on federal taxes. So for example here, I was just talking to a client yesterday. He subbed to a deal and he got in at 0% and he's asked to renovate it. So he picked up a $250K home in West Virginia, and he's real estate professional status though. So he just created, he's probably going to get probably a $40,000 to $50,000 accelerated depreciation on that. So he just created a $40,000 to $50,000 expense by doing nothing because he's just using leverage, and that will offset his wife's income now. So then that's just the hit. So that's always why you have like power couples, where you have one person that like makes all this money, the other person's like the real estate person, and they combine in. This is why the tax code's so efficient. This is why like rich people don't pay taxes seriously. So this is huge if you're not using it. You can accomplish this if you are single, as long as you just are doing all your rentals yourself. But yeah, everyone in this room here, make sure to get it. I don't see why not. Yeah, just because of what you do. Now, the not so fun stuff about this though is that you have to document. So under audits, I have an IRS tax auditor on my team. So like we know like what they poke holes at. So the things that they're going to poke holes at. So if you don't have this today, you should probably do it. Is like, so your real estate professional status, they're going to look at your hours log. So if you're not documenting your hours, document your hours, who, what, when, where, why. Do it to the every 6 minutes, just like your attorney is going to bill you by the 0.1. Do the same. So that's the big thing, is documentation on that side. So use a calendar, use an app like Clockify, use something. The other areas where the IRS tax auditors like to poke holes at is your mileage. So everyone here probably drives a crap load. And if you don't have a mileage log and you try to claim mileage deductions, they're just going to disallow that. So you're going to lose it. So easy apps, Mile IQ, QuickBooks, they have it. I mean, you can just go pen and paper too. It's just like, where did you go? Where did you start? Where'd you go? When? How many miles was it? Pretty simple on that side. And then your meals and travel, that's the other areas where the IRS will poke holes at. They want to see more agendas logged. So if you're eating out with the client, write down who did you eat with, why did you eat with them, snap a photo of the receipt, and then just store it away. If you go travel too, so if you want to go to Japan or something for your like company like board annual meeting, document why did you go there, and then who are you with, like have the full agendas. If you don't have the agendas, you will lose under an audit. And then lastly is this the basic receipts that everyone hates. So if you don't keep track of your receipts today, every time you have a receipt, just bust out your phone. I know everyone's always on their phone, right? Just take a photo and have it done. So a lot of modern day tools that really help with it. So documentation is key. So documentation. No one likes it, but that's why we're here. And then, yeah, some strategies for your clients here, just put in here. So as you're thinking about and like bringing ideas, so, just what value add can you always be for your client? The biggest things that, some of our realtor clients call us for, and, just sharing like what we hear and what their clients are always confused about. The first one would be the short-term rental loophole. So short-term rental loophole, this is essentially just your Airbnb. So if you have an Airbnb, this is for your high W-2 people. So you have people in their high W-2, this is the go-to strategy for them. What it essentially is that you have an average stay of 7 days or less. So the stays are fast, as long as you average out the whole year as 7 or below. And then from there, you material participate again. So like 100 hours or you substantially performed all services, you'll qualify. And the whole point of that is now that, say you buy $1 million home, you pick up $200,000 deduction, and that'll reduce their W-2 income. So this is really good for your clients that are in high W-2, all the tech worker folks. That's like our go-to strategy for the short-term rental loophole, and a lot of documentation related towards this side. But you can hack it too. We've had all the clients where they have their existing home, and then they'll just like house hack it, put like 2 rooms on Airbnb, and the other 2 they live at, and then we'll just take 50% of the home or square footage, depending on how aggressive they want to be with it. So the short-term rental loopholes are a really great strategy for your clients, probably yourself, even if you want to get into it. So that's the good one there. And then this is like super juicy now that 100% bonus depreciation is back. So without 100% bonus depreciation, this strategy was kind of phasing out. It wasn't as good. So now it's 100%. It's, makes it worthwhile to do it. So even if you do a second home, 10% down, you still get the benefits no matter what. And that's why the tax code's so efficient. Is like they encourage you to, pull leverage out. So it's always like, hey, you don't actually spend the money to get the deduction, you get the full deduction no matter what. The next part is the homeowner's exclusion. So I think, this is section 121, and it's the, lived in it and owned it 2 of the last 5 years. So you get $250,000 tax-free. If you're single, $500,000 if you're married. One thing that we did learn is you could technically, if that person lived with you in that house for 2 years, and like say you're just like boyfriend, girlfriend, and you could get married on the last day of the year, and you'll get that $500,000 actually. So that was like one thing that was like, oh wow, shocking, that we looked into. So that's another way to like exclude a ton of money on the house sale. They had to live there though with you for 2 years. That's the other issue though. They have to actually move in. So this is how you can sell your primary home all tax free. And I think most people hear about this one. The one part though that is just maybe if you're not aware of is there is actually partial exclusions. So partial exclusions, there's like a list of maybe 6 to 8 reasons, I believe, where you can still qualify for a partial exclusion. Partial exclusion simply states that if you like got deployed, you had like a medical emergency, a family emergency, and you have to move like cross country back home to like take care of people, then you can actually qualify for a pro rata. So say you only lived there for 1 year, you can still get half that deduction. So there's pro rata rules. So if your clients need to leave their homes and sell it, this could still be very powerful for them. And then, let's see. Oh, the other one I forgot in here. Oh, installment sales. Forget the slide. So installment sales, what this is this essentially just if your client's like so like spooked about the capital gains, but you're still trying to like confirm and get the transaction done. One hack that you could do is just do an installment sale. So essentially, instead of like recognizing the full gain, they can actually defer out the gain over a long time period. So say if you want to sell the home and you set up the sale to be, hey, over 5 years, then you only pick up the cap gains over the next 5 years versus picking it all up in year 1. So installment sales are, a big area where you can really, get the sale done and also still like not kill, the client won't have to pay so much in cap gains taxes. And then there's one I didn't put in here, but there's another one too, is like the capital gains, because the biggest part is just like people are always concerned, like, hey, I got to sell my home. Oh, there's so many capital gains taxes. One area that you can use is tax loss harvesting. So this is where you can create, we have one partner that we work with, you can create capital losses on purpose to reduce capital gains. So this strategy actually came out, one of our guys, he sold a business for $3 million, and then he looped us in with his like guy he played golf with. Seriously, the rich get richer. Like the more I do this job, I'm like, dear God, just having access to all these people. But what he does is he leverages your portfolio, your stock portfolio, and then creates capital losses. So he'll buy a stock of Pepsi today, wait for it to drop a few dollars, and then go buy Coca-Cola. So then you avoid wash sale rules, but you create a capital loss that will then offset your capital gains. So other ways to really reduce capital gains for your clients. But yeah. Oh yeah.
So, on the installment thing, so if your client has a rental
Mm-hmm.
and they're selling it, a lot of capital gain,
Yeah.
can they use that?
The installment sale, yeah, they can definitely do that.
Even if
Or
it's a rental?
yep, yeah. Or they could also do a 1031 exchange. So
We all could do that.
yeah. Oh yeah. That's why like yeah, most people are familiar with 1031s. Yeah. Oh yeah. It's just an alternative. Just because we hear it a lot, we're like, no, they don't want 1031. What else you got up your sleeve? And I was like, installment sales work pretty well. So just
And you
other
can keep
ideas.
doing that, like 1031, not pay the whole. Is it gradual?
The installment sales, you recognize a capital gain over the lifetime period of the contract.
Oh.
Yeah. So if you structure where like, hey, I got $1 million house, cool man, just $100,000 per year, then you only recognize the cap gain on that incremental $100,000 per year. So you space it out. So a lot of folks that are, say if they are like these retirees, they don't have a lot of income, you can sell stocks and get the first $96,000. If you're below that, they pay 0% cap gains taxes actually. So they could structure it where you have barely any cap gain. If they do a little bit more, it's 15%. So there's the tax code can really be efficient. So even if they want to sell, like, hey, it's not gonna be that bad, dude. Like I got a tax plan for you, and as long as you can just reduce it and they won't be spooked by it, I think you'll be able to close the deal better. Yeah. Cool. Let's see here, and then exclusion, talked about that. Yeah, and then I think overall, yeah, this is like our services, what we do. Big things is tax planning. So if you remember nothing I said today, do some planning versus no planning. Like I always compare it to fitness. I'm like, dude, just go take a walk versus not walking at all. I really don't care. Drink some water. Same thing for taxes. Like, do something. Just don't do nothing. Unless you just want to tip the government. That's fine. It's not my agenda, but I just don't like paying taxes. But yeah, tax planning, tax filing, accounting. We do it all full service in-house on this side. And then, yeah, if you want to book a call with one of our tax strategists, they can help guide you on that side. Feel free to scan the QR code on here. And then also, if you want to, these slides we can recirculate back out too. So I think I probably captured most of your info from some QR codes to this, and then we can blast it all out. So you can put as much money back in your pocket versus giving to the government. With that, got a little bit extra time. Does anyone have any questions that they want to ask about their taxes? Yeah. Oh, it's your time right now. Yeah. 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 We saved 10 minutes for you here. Yeah.
What's your number?
254 CPA dude.
254
CPA dude.
CPA.
Dude.
What are
Yep.
your rates?
Rates, they start depending on filing. Filing start at 1,500, go up from there. Planning starts at $7,000, goes up from there. Yeah. So usually we find like, on average, most of our clients we save about 30 grand for. So usually the first couple of years working with us, it's free. And then afterwards, it's like, you could not use us or you can continue. This depends on convenience wise. Yeah.
Something missing, you said 254 CPA, what's the last one?
Dude, D-U-D. Oh yeah. Yep. Yeah, right here. Yeah. Everything's a CPA dude. So like our website's a CPA dude, text line's 254 CPA dude, Instagram's a CPA dude, TikTok's a CPA dude. So it's all CPA dude. Cool. Yeah, definitely. Yeah. Okay, cool. Yeah, if there are no other questions, yeah, hopefully everyone took something away from this. Yeah, got some food. Hopefully we smashed all the food there on that side. Yeah.
So you talked about S corp, right? Is it
Yeah.
like similar protection as LLC?
Oh yeah, so your LLC will be elected as an S corporation. Yeah. So you have LLC elect S corp, or you have C corp elect S corp. Yeah, it's just a tax election. Lipstick on a pig. Yeah, so you have all that protection still. Yeah. Great. Cool.
Is this a video, is this being recorded?
Yeah. Yep.
Oh, can we get a copy?
Oh yeah, for sure. Yeah, I think we got your contact info somehow, and then we'll circulate back out. Yeah.
You were good.
Oh, thank you. Oh, thank you.
You're a good dude.
There you go. I did my job. Yeah. Dexter.
So if we decided to utilize your services, we'll be working with you or is somebody on your team?
Most people go with my team. I take like a select few if they're on our higher packages and whatnot. Yeah. But yeah. 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 The other Tony will take clients. Yeah. Yeah. He's got it down. Yeah. Yeah. Trust?
Assets,
Oh yeah.
real estate assets.
Oh yeah. Yeah, we got an attorney down in Palo Alto, John Martin. Yeah, he's really like tip and tier. Yeah, tidied up. Yeah.
So guys, please register this form with Tony to get a slideshow.
Oh yeah. Yeah, that'd be great.
Where's the board?
Yeah. Question?
Do you have a team can speak Mandarin? Mandarin speakers?
Uh,
Your team can speak Mandarin?
I know one dude used to teach. He's my COO. He used to teach Chinese, or he was in China for a couple of years. I don't know how good his Mandarin is though. I speak really bad Cantonese. Yeah. Yeah. Mandarin. Yeah. Not so good. Yeah. 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 Ho siu. Yeah. Pa chao. Yeah. Yeah.